Amy, thank you so much for being here with us on obviously what's been a really busy market today for everyone.
Yep.
One of the main objectives of the Northwestern Endowment is to generate returns in excess of the spending. But at the same time, you want to do that by limiting volatility of the investment pool. In this environment, how do you do that, and what's keeping you up at night?
Great, thank you, and thank you for having me. It's nice to get away a little bit. It's interesting because to generate returns, we have to embrace volatility. But we try to manage volatility in a couple of ways. One is to have diverse sources of volatility, things that aren't correlated, so that the overall pool is less volatile than probably any individual or many of the individual components. The other thing we try to do is analyze the historical patterns in volatility, and obviously correlations change and they're not stable. So what keeps me up at night is the pace of change and the way that I think we may be entering a kind of regime shift in terms of markets, interest rates, inflation, globalization. I think I may have mentioned I started in Wall Street in 1989, and the Berlin Wall came down maybe a month after I started my job. So most of my career has been in a period of increasing globalization, mostly declining interest rates and mostly low inflation. So I think we're in a different world. And that means all the analysis we do on historical volatility and interest rates and the relationship between the economic cycle and inflation, we have to think about what's the right historical period to look at. So the geopolitical risk, which I think is higher than I really can remember, and it's not just the last 6 weeks, it's really been, I think, increasing. More regulation, and that's true in many countries, is putting more sand in the gears and making things a little bit more unpredictable, and that definitely keeps me up at night.
And thinking about that geopolitical risk, regulatory risk, and the political influence that you see in markets these days, how is that influencing your asset allocation? Is there anything that you changed or you were planning to change in terms of the endowment's asset allocation?
Yeah, so there's probably three answers to that. We are still committed to international diversification. That actually hasn't been a great strategy for the last decade. I mean, there were probably 7 stocks, maybe QQQ is all you really needed to own. But but I think we are of the view that if we're moving into a world of several fortresses, Fortress U.S., maybe Fortress Europe, maybe Fortress Asia, China, there'll probably be winners in every fortress. And so as long as we are legally able to invest globally, we will continue to invest globally. So that's one thing that we're not going to change. I do believe that we have decided to have a slightly higher allocation to cash. And that is for a couple of reasons, one of which I think we'll get to later, but one is just more volatility, markets moving sharply. We also have a big payout rate of 5% a year, which is real. So we want the option value of cash. We want the liquidity. So I'm not talking about huge amounts, but I'm saying going from, say, a 4 to 5% cash and treasury allocation to more like 6 or 7. So this is not cataclysmic. But I think in some ways what we see happening is higher rates and potentially lower overall equity market returns, kind of a flatter risk curve. So I think having a little bit more dry powder makes sense. And that gets at the third point, which is I believe that to largely increase tariffs, increase regulation, I'm old-fashioned. I think that decreases profit margins and return on equity broadly. It doesn't mean there won't be winners and losers, but so I see the risk that equity returns in the aggregate, return on equity is lower. And so if you have higher rates, lower equity returns, I think that implies slightly different allocations. But as you said, we got to get that 8-9%, so we are not going to get rid of equities.
Fair enough. And then thinking about it's been really, really hard for money managers to beat the S&P 500 in the past, in recent years. And, you obviously joked about, all you have to hold is QQQ, I guess. But my question to you is, one of the things we've started seeing is that there is a huge dispersion now in the sub-indices, and what does that really mean, and what opportunities does that present? When Northwestern is thinking about that dispersion we're seeing in the sub-indices performing so differently one from the other now, are there opportunities that you see? Do you see like more an opportunity to like pick more individual stock pickers, or?
Yeah, so we actually like this dispersion, and we had never given up on active management. I think, again, it was looking like a tough slog, but I believe in the long run, we are fiduciaries. We want to pick and invest in the best companies. And in the long run, I think those will generate the highest returns. I think also a higher interest rate environment is a higher cost of capital. A higher cost of capital rewards businesses that allocate capital well and generate a higher return on that capital. So I think to some extent, when you have zero interest rates or close to, or even negative real interest rates, the rising tide lifts all boats. And it makes it very hard to short, and it makes it, frankly, kind of hard to get punished if you pick bad companies. Bad companies can live for a lot longer. So I think that for a lot of reasons, we do believe in the fundamental stock picker model. I think we have a very long time horizon. We're not trying to beat the market by a week or a month. We're trying to generate returns over decades. And because I think the other piece of this is the rise of algorithmic trading and quantitative trading and passive all together kind of are the forces that make momentum work and are a little bit against the fundamental stock picker. Those are real. Those are not going to go away. But I think they tend to be shorter term in their impact. And I think what we really look for is money managers who have concentrated portfolios, 10, 15 stocks, who also have, and this is a little crazy, but we actually like longer lockups because I want them to have a time horizon. Even if they're trading in liquid markets, I want them to be thinking on a 3 to 5 year. If I want the guy that's day trading, it's probably a highly quantitative strategy. But for the real business owners, I want them to think like business owners.
And how are you thinking about it? Are you allocating more of the money to individual stock pickers, or? Yeah,
I would say we, over the last few years, probably the last 5 years, have increased our long-short allocation. Again, that gets easier when rates are, it's very expensive to short, and it's good to have a rebate. So we like that, but we also like the failure potential that I think gets higher when you have higher cost of capital. So we've probably doubled our allocation to long-short managers, which I think of as the ultimate stock picker. And we've also moved, we always have had a lot of private equity, which is a different question, and venture. But within the public equity portfolio also, we have begun to move towards funds that really are willing to own 15 stocks rather than 30 to 50. And again, that's because we have several of them. I'm not saying individuals should go out and do that, but I think as an endowment with 20 public managers, if they all have 50 stocks, then you're basically running an index fund. So we are looking for high conviction stock pickers.
And for universities, of course, the elephant in the room right now is the endowment tax and that increase. Can you tell us a little bit your view on what that means for Northwestern and how Northwestern is preparing for it?
Yeah, so it seems quite likely that the endowment tax will be increased, which I will say I think is a little sad, just to the innovation of the QQQ. And this country has a great history of innovation, some of which has been because we have the greatest research universities in the world. And I feel cutting the resources available to our greatest research institutions, in my view, is not really that smart. But I get it, and it's coming. So it's not above my pay grade to opine on that. It will be a significant change in that we have to start thinking a little like taxable investors. The tax right now is on realized gains. We have to realize gains. We spend out of it's a $14 billion endowment. We harvest $700 million a year that we pay out to the university, a little more than that. So I will have to have liquidity. I'm going to have to generate liquidity. We usually, in the past, have always generated from whatever was doing the best and where we had the liquidity. And we now will probably take into account the tax implication as well, which is, lots of people do that all the time. We didn't have to do that. I also think we will probably have to have a little more liquidity, particularly. So again, part of that increase in cash is just recognizing that there's some non-zero chance that the pay rate has to go up because some of it's either going to come out of the university's budget or it's going to come out of the endowment's payout. It might be a little bit in between. So we need to be prepared for that. And I think, it's interesting because we have had long time horizon advantage. I do think privates have been an important source of that. You don't control your distribution typically, although we might start asking for stock instead of cash distributions. It's a little bit technical, but I think we're probably going to need more liquidity also. So it's a tension because we have to, we probably want to drive towards higher returns, but we'll probably need more liquidity as well.
And we're seeing that at the same time as we're seeing universities face some federal cuts. Can you talk a little bit about Northwestern's experience and how do you prepare for that? What consequences does it have for an endowment and the university as a whole?
Yeah, I think the important thing is as an endowment manager, we manage money on behalf of the university. So everything we do is in service of the mission of the university. It's a little different than just running money. So we have to think about how the university will manage declining resources. That is, and again, there's three different places. One is direct cuts in research funding, so like the NIH capping. And I will just take a moment to say indirect costs are not exactly just overhead. It's typically facilities, equipment. Most, for Northwestern, like many universities, has about 40% across all grants. So capping grants at 15, part of what costs money in indirect costs is if you have a really expensive microscope and many labs use it, it doesn't get allocated to one research project. That's a shared resource. I wouldn't call that overhead. It is, but it's fixed costs that are generally shared. So I think these are real cuts, and they will result in potentially less resources, almost certainly less resources available for research budgets. And the tax will be more general budget, which, of course, the endowment supports financial aid. It actually keeps tuition lower. A lot of people are confused and think tuition dollars go in the endowment. The endowment has no tuition dollars in it. It's because of the endowment that tuitions actually aren't higher, and that we have the financial aid resources to have, for instance, no loans and no limitation on student access at Northwestern. So those things are, at risk. But so I think I worry about the impact in the U.S. for innovation. Even the internet, grew out of Defense Department spending, way back. I know I am visited by a delegation periodically from Japan, where the Japanese government has just put $70 billion into a fund, the government, to fund research universities in Japan, because they noted that their competitiveness in terms of innovation was slipping. So I just, we don't have a biblical right to innovation, and most people in this room are global. But I think as a country, we profited from having great universities, and they're great. They'll stay great, but they're going to have to figure out how to fund themselves.
You talked a little bit about, also thinking more closely on how you realize gains. And then at this point, we do have a question coming in from the audience. Last year was a record-breaking year for U.S. ETFs. So how are you thinking about ETF, the pros and cons as we move through 2025?
Yeah, so I love ETFs, especially as a person, because they don't distribute gains, which is great. I do think we have thought a lot about, and probably will continue to have, the need for liquidity. That's a very nice solution for us. So we'll probably have, continue to have stock pickers. as I said, I like to pick people and give them capital with certainty, so they know they have 3 or 5 years. So to balance that, I probably want something very liquid, and where I don't have to, I can control the tax implications. So I think there's a role even for institutions with these instruments.
Mm-hmm. And we've got another question coming in from the audience. Amy, can you please talk about the details of private equity allocation and some themes around triggers from PE allocation?
Sure. So we try really hard to be steady Eddie in private equity and venture and any private asset class. But there are some, triggers. I think one thing that happens with private equity and public equity is the public markets adjust way more. So, if you're trying to manage to say a 20% allocation to private equity and then the public markets drop 20%, like suddenly your private equity doesn't drop, you've got more of it. So we try to ride through those cycles. I think, broadly speaking, this is probably a decent time to be making commitments, but we have seen slower return of capital, obviously less good returns in the last couple of years. So that's sort of, I think that means actually our public equity is high now relative to our private equity. But we try to be steady. I think the worst mistakes institutions make are getting out of, I can remember nobody put money in venture in 2011, 2012, 2013. It turned out to be the best, great vintage years. So it's very dangerous, I think, in these super long duration asset classes to hit the brakes too hard, or frankly, hit the accelerator too hard when it looks good. I'm not sure if I answered that question. It disappeared, but I'm just trying to remember what it said. But there are. I think it's important to stay steady, even when. But overall, I would submit we'll probably have to have a little less allocation to privates, given the amount of tax and uncertainty.
Yeah, I do think you answered that question.
Okay,
so
thanks.
Last but not least, let's talk a little bit about AI and how is that changing the way you do your job and how are you using it to make investment decisions if you're using it at all?
Yeah, so I would say there are two things. One is we've got to understand how other people are using it. And I think there are managers who are deeply using AI. Of course, they've been using AI, the quantitative AI, forever. Not forever, but for a long time. The large language model in revolution is a little newer. But we still see, very interesting applications. And clearly, there are franchises that have invested enormous amounts of money into their technical and computing capability. We like to understand that. We feel like we need to understand that. For ourselves, what we're finding is similar to what an earlier panelist said. There's a lot of rote work and reading that we can really start to push to have AI help with. Legal documents being an obvious example, but also when I look at a new manager, I like to read every letter they've written since they went into business and then kind of make themes. And I used to go through and highlight, when did they sell the stock? I think it's kind of nice to have AI summarize, read all these letters and summarize what they bought and sold over the last 10 years. That's kind of makes life easier on the young people that don't have to do that.
And are there moments where you say, like, the bots are already helping us make decisions, invest here or there?
I think they're helping us digest information. One thing about endowments, we're pretty unconstrained. We could invest almost anywhere, and there's just so much information. So I think they're not really making decisions for us yet, but they're helping us wade through more information and be more productive.
Mm-hmm. And as you think about 2025, what industries are looking particularly attractive this year and maybe in a 5-year horizon?
Yeah, we've been doing a lot in biotech. It's been kind of an unloved sector, and in spite of the cuts in funding, I still think there's a lot of upside there. We also, China got really cheap. We put some extra allocation there. That's politically very difficult to handicap, but the PE multiples look very attractive. We're seeing a lot of interesting stuff in venture, so it's a kind of an interesting moment. We're seeing a lot of young firms starting, many with great pedigrees from very well-known franchises, so we're spending time on that. I think credit is still interesting. I actually was worried about private credit with the increase in rates, and we haven't really seen a default cycle, and kind of would have expected one by now. So I want to be careful, but I think as we move through into potentially, we do have worries about a recession. I think we'll see default rates. I think that's a space we'll want to keep an eye on for an entry point.
And in terms of recession, how quickly or could that be coming?
That's so hard to handicap, but I do feel there are a lot of headwinds to the economy right now. Fiscal contraction, sticky rates, obviously the stock market's not doing great. And I think the tariffs create a lot of uncertainty for businesses who are trying to figure out how to invest. So I see sort of fiscal contraction, potentially business spending contraction, consumers probably a little nervous. And I think it's going to be hard for that. The Fed can lower rates. That doesn't necessarily drop the 10-year, right? So I think you could see curve steepening. And so I think, to me, it's more than 50-50 this year.